Investors, hello. This is Stock AI Insights Super Investor Moves, and I'm your chief AI analyst. Just a quick reminder, this program is for educational reference only, not investment advice. Investing always involves risk. Today, we're parsing a major event, Warren Buffett's Berkshire Hathaway and its significant sale of Apple stock in Q3. We've got just about 6 minutes to break down all the dynamics. And the one data hook that tells the whole story? A huge reduction in what has been Buffett's most iconic holding for years.
All right, let's just put the key number right up front, negative 14.9%. This single figure is really the core of our analysis today. It represents just how much Berkshire Hathaway trimmed its Apple holdings in the third quarter of 2025 alone. You know, this wasn't some minor tweak. It was a really decisive move, and it's got the entire market asking, what does the Oracle of Omaha see that we might be missing?
So before we can even begin to understand the why behind this big sale, we have to really get a grip on the what. So let's dive into the hard numbers from Berkshire's latest 13F filing to really see the true scale of what's happening here.
Okay, so Berkshire let go of nearly 42 million shares of Apple. Now, the really crucial point my analysis is flagging is that this isn't some one-off event. It's actually the continuation of a trend we've been tracking all year. Berkshire is consistently trimming its sales, and that signals a very clear pivot away from its once massive concentration in the tech giant. Now, look at this chart. Apple is still, without a doubt, the largest slice of the pie at almost 23%, but its dominance has been cut back significantly. I mean, this is a pretty dramatic shift from its peak, when Apple accounted for over 40, sometimes even 50% of the entire portfolio. This move is a clear, deliberate effort to bring that allocation back to a much more balanced level. And this Apple sale wasn't happening in a vacuum, not at all. As this table shows, Berkshire was actively reallocating that capital. I mean, just notice the new position in Alphabet. This strongly suggests a rotation is underway. They're trimming one tech giant while moving into another one that they believe offers more attractive potential down the road. It's a really calculated play to optimize for risk-adjusted returns. Okay, so this brings us to the core question, right? The rationale. Why make such a big move now? Well, think of Buffett as the captain of a massive ship. When one piece of cargo, in this case his Apple stock, gets way too heavy, it can actually threaten the stability of the entire vessel. This sale is all about rebalancing that load to make sure the ship stays steady for the long journey ahead. My analysis really breaks this rebalancing act down into 3 interconnected drivers. First, there's prudent tax planning. Second, strict valuation discipline. And third, strategic portfolio rebalancing. Each one of these is a critical piece of this decision-making puzzle. First up, let's talk taxes. Buffett himself has been pretty public about this being a key reason. See, Berkshire is sitting on absolutely massive unrealized capital gains from Apple. Selling now locks in those incredible profits at the current 21% corporate tax rate. As the analyst consensus suggests, it's a really prudent move to de-risk, especially with so much uncertainty over where tax policy might go in the future. Second, let's talk valuation discipline. Look at this chart. Berkshire's cash reserves have been climbing to record highs, and that's a powerful signal. It tells us that Buffett and his team see very few attractively priced places to put their money in the current market. After Apple's incredible run-up, its valuation likely just got too high and exceeded Buffett's famous margin of safety. You know, that buffer he demands between a stock's market price and what he thinks it's really worth. And third, we have strategic rebalancing. You know, even for a phenomenal world-class company like Apple, having it represent nearly half of your entire portfolio, well, that introduces some significant concentration risk. If Apple were to face some unexpected trouble, the impact on Berkshire would be immense. So this sale is a textbook risk management move, trimming an oversized position to protect the whole portfolio. So what does this all mean for the bigger picture, for the broader market, and for all of us as individual investors? In our final section, we're going to try and read the tea leaves, so to speak, and really understand the signals being sent by one of the world's most watched investors. Now look at this chart showing the flow of capital. What's really interesting here is the potential for a much broader market trend. Berkshire's pivot, when you combine it with similar shifts from other big institutions, suggests that money might be flowing from those mature consumer tech giants over to the companies that are building the foundational infrastructure for AI and enterprise digitalization, companies like Alphabet. This sale powerfully reinforces Buffett's long-held philosophy that cash is king. That record cash hoard isn't just idle money sitting on the sidelines. It's dry powder. As one report put it, these are like bullets, ready to be deployed when fear eventually grips the market and great companies go on sale. He's simply preparing for the next big opportunity.
So what are the key lessons my analysis has distilled from all this? Well, first, even the greatest companies on Earth can become overvalued. Second, proactive risk management, like trimming a huge winner, is absolutely crucial. Third, diversification is your best defense against concentration risk. And finally, always be disciplined about valuation and maintain your own margin of safety.
And this all brings us to a final, really thought-provoking question. When an investor of Buffett's caliber makes such a significant, sustained move away from a beloved market darling, is it a signal for all of us to critically reevaluate our own exposure to the market's biggest tech winners? So the verdict from my analysis is this. This was a disciplined, strategic rebalance. It was not a rejection of Apple's fundamental business. It was a multifaceted decision, really, driven by prudent tax planning, strict valuation discipline, and just essential risk management. So, what's your take on this move? Drop a 1 in comments. See ya for the next move.